Bitcoin has a habit. Every single year, right around this exact time, something strange happens to the price chart. Investors who spent the summer feeling confident suddenly watch their portfolios turn red. And nobody ever seems fully prepared for it. History has a name for this pattern, even if most people have never heard it. Some traders call it the August curse. And this year, on the 4th day of August, 2026, with Bitcoin sitting close to $63,500, after tumbling from an all-time high of over $71,000 set back in June, that curse feels like it might already be knocking on the door again. But here's the twist nobody is talking about yet. This August is not behaving like any of the ones before it. There is a force working against the curse this time, something that never existed during previous crashes. Stick around because by the end of this video, you are going to understand exactly why some analysts are bracing for another painful drop, while others are convinced this could turn into the most explosive August Bitcoin has ever seen. Before we go any further, quick disclaimer. This video is for informational and educational purposes only. Nothing here is financial advice. You should always do your own research or speak with a licensed advisor before making any investment decision. Markets are unpredictable and past patterns never guarantee future results. Okay, now let's get into it. If you're new here, welcome to the Wealth Continuum. This is the place where we break down markets, money, and the patterns that actually move your portfolio without the hype and without the noise. If that sounds like your kind of channel, you might want to stick around for what's coming next. Now tell me something before we dive deeper. Where are you watching this from right now? Are you checking your portfolio while this plays in the background, or are you just relaxing after a long day? Drop it in the comments. I actually read them. Let's start with the numbers, because numbers don't lie even when emotions do. If you pull up Bitcoin's monthly performance, going all the way back to its earliest years, one month keeps showing up in a way that should make every investor a little uneasy. August. Year after year, it ranks among the weakest performing months for Bitcoin, trailing behind months like October and November, which have historically been some of the strongest. Think about 2017. Bitcoin was riding one of its biggest bull runs ever. Then, August rolled in, and momentum stalled hard before the real fireworks even began later that year. Fast forward to 2019, and August delivered a brutal double-digit slide that caught a lot of traders completely off guard. 2022 was even worse, with August acting almost like a bridge into one of the ugliest crypto winters in recent memory. 2023 followed a similar script, quiet on the surface, but grinding lower underneath. And even in 2025, a year most people remember as strong for Bitcoin overall, August still managed to interrupt the party before the market found its footing again. Do you see the pattern forming here? Bull market builds, optimism spreads. Everyone starts talking about new highs. And then August shows up, and momentum just disappears into thin air. Is that a coincidence? Or is there something structural happening every single year that keeps repeating itself like clockwork? Here's what makes this even stranger. This isn't a pattern that only shows up in Bitcoin. If you look at traditional stock markets, you'll find similar seasonal soft spots too. Old Wall Street traders have talked about weak summer stretches for decades. But Bitcoin's version of this pattern tends to be more violent, more exaggerated, and honestly, a lot less forgiving. A 2 or 3% dip in a traditional index can turn into a 10 or 15%. That's the part that catches new investors off guard every single year, because they assume Bitcoin will behave like a stock, and then August reminds them it doesn't. Stay with me, because the next part is where this starts to make a lot more sense. Here's what most retail investors never stop to consider. August isn't just another month on the calendar. It sits right in the middle of a very specific liquidity gap, and that gap changes everything about how the market behaves. Think about who actually moves the big money in crypto. Institutional desks, hedge funds, large trading firms. And guess what a huge chunk of those people are doing in August? They're on vacation. Trading floors go quiet. And when volume drops, something dangerous happens to the market structure itself. Thin order books mean that even a relatively small sell order can move the price far more than it normally would. Imagine a swimming pool with very little water in it. Toss in a rock, and the splash looks massive compared to how it would look in a full pool. That's exactly what happens to Bitcoin during low liquidity months. A seller who wouldn't normally cause a stir suddenly triggers a domino effect of stop losses and liquidations. On top of that, you've got exchange-traded fund flows that tend to slow down during the summer lull. Options contracts expiring and forcing dealers to hedge in ways that add extra selling pressure. And institutions doing their quarterly portfolio rebalancing, which often means trimming positions that had a big run-up earlier in the year. Put all of that together and you get a month where even modest selling can snowball into something that looks a lot scarier on the chart than the actual news would justify. A single large holder deciding to take profit, one who's been sitting on gains since earlier in the year, can trigger a chain reaction that has absolutely nothing to do with Bitcoin's actual long-term fundamentals. It's not that the technology broke. It's not that adoption slowed down overnight. It's simply that there weren't enough buyers standing on the other side of that trade to absorb the pressure calmly. And here's a question worth sitting with for a second. If so much of August's volatility comes down to thin liquidity, rather than any real change in the underlying value of the asset, does that make the drop an opportunity instead of a warning? Something to think about as we keep going? But that's only half the story. Here's what they're not telling you in most of the headlines. Zoom out even further, and there's a bigger rhythm running underneath all of this. Bitcoin operates on a roughly 4-year cycle, largely tied to something called the halving, which is the process where the reward for mining new Bitcoin gets cut in half. Look at the years 2017, 2021, and now 2025 moving into 2026. Each of those windows followed a similar emotional arc. A halving happens, excitement builds, prices eventually surge, and then, right in that stretch of exhaustion after the initial euphoria fades, August often becomes the month where retail traders who bought near the top start to capitulate. Ask yourself this: is 2026 just another turn of that same wheel? Liquidity cycles tend to echo. Market psychology tends to repeat, because human beings tend to repeat their mistakes, generation after generation, bull market after bull market. And retail exhaustion has a way of showing up right when everyone least expects it, usually disguised as boredom, right before it turns into panic. This is exactly why a lot of experienced traders actually expect a little weakness before real strength returns. They've seen this movie before, and they know how it usually ends. Think about it this way. If you knew with total certainty that a stretch of turbulence was coming before the next real leg higher, would that change how you're positioned right now? Would you be holding cash on the sidelines, waiting for a better entry? Or would you rather already be in the market, willing to ride out the noise? There's no universally right answer here. It really depends on your own risk tolerance, your timeline, and honestly, your own stomach for watching red numbers on a screen. Comment below if you remember what you were doing during the last major Bitcoin crash. I want to know how many of you actually held on, and how many of you sold and regretted it later. Be honest. This comment section is a judgment-free zone. Now here's where things get really interesting. And honestly, this is the part of the video you don't want to skip. This August is not like 2017. It's not like 2019. It's not even like 2022. Something fundamental about the ownership structure of Bitcoin has changed, and it changed fast. Spot Bitcoin exchange-traded funds, which barely existed a few years ago, now represent a massive chunk of demand flowing into the asset. Public companies are holding Bitcoin directly on their balance sheets as a treasury asset, something that used to sound almost absurd a decade ago. There's growing chatter about nation-states quietly accumulating positions. Stablecoin liquidity sitting on the sidelines is larger than it has ever been, ready to deploy the moment sentiment shifts. And an entire new category of publicly traded Bitcoin treasury companies has emerged, essentially existing to accumulate and hold the asset for the long run. Wall Street, which used to treat crypto like a fringe experiment, is now deeply embedded in it. So here's the real question. Do these new buyers change the entire equation? Does a market with this much structural, long-term demand even have room for the old seasonal curse to play out the same way it used to? Consider this too. Back in 2017, when the last major August pullback hit hard, there was no such thing as a spot Bitcoin exchange-traded fund in the United States. There was no wave of public companies parking treasury reserves in Bitcoin. There was no meaningful stablecoin market acting as dry powder on the sidelines. The buyer base was almost entirely retail traders, individuals making emotional decisions from their phones, often with very little risk management in place. Compare that to today's market, where large institutions with dedicated risk desks and long-term investment mandates are sitting on substantial positions. Does that change how a sell-off actually unfolds? Does it change how deep it goes and how quickly it recovers? This is where it gets really concerning for anyone betting purely on history repeating itself. Because history has never had to compete with buyers like this before. Right now, as you're watching this, there are two forces quietly pulling against each other, and neither one has won yet. On one side, you've got historical seasonality, decades of pattern recognition telling traders that August tends to bring weakness, thinner liquidity, and profit-taking after a strong first half of the year. On the other side, you've got institutional accumulation working in the opposite direction, ongoing exchange-traded fund demand, corporate treasuries continuing to add to their positions, exchange balances shrinking as coins move into cold storage and long-term holding wallets, and a growing group of long-term holders who have made it very clear they simply refuse to sell, no matter what the short-term chart looks like. Which force wins? Nobody knows for certain, and anyone who tells you they know with absolute confidence is probably trying to sell you something. But understanding this tug-of-war is exactly what separates people who panic sell at the bottom from people who actually understand what's happening beneath the surface. Here's a way to think about it that might help. Imagine two teams playing tug-of-war over a rope, except one team gets stronger every single month as more institutions build positions, while the other team's strength depends entirely on the calendar and resets every single year regardless of what actually happened the year before. Over a long enough timeline, which team do you think eventually wins more rounds? That doesn't mean the seasonal team can't win this particular August. It just means the long-term math might be shifting in a direction a lot of people haven't fully priced in yet. Stay with me, because the next section is where the macro picture comes in. And this is the part that could genuinely decide everything. Let's talk about the bigger picture for a second, because Bitcoin doesn't exist in a bubble. It reacts to the same forces that move every other market on the planet. The Federal Reserve's next moves on. Interest rates are sitting front and center right now. Bitcoin has already shown this year, especially through the rough stretch in June of 2026, when exchange-traded funds saw roughly $4.4 billion in net outflows during what became one of the worst months on record for Bitcoin fund flows. It is deeply sensitive to shifts in monetary policy. Dollar strength has also been a headwind, with a firmer dollar generally putting pressure on risk assets like crypto. Bond yields, inflation data, and employment numbers are all feeding into the same story. And you can't ignore geopolitical risks sitting quietly in the background. It's always capable of triggering a sudden risk-off move across every market, not just crypto. Here's the thing. It's one unexpected macro surprise. Whether it's a surprise rate cut, a hotter-than-expected inflation print, or a shock from somewhere in the global economy, could completely rewrite how this August plays out. That's the part that keeps professional traders up at night, far more than any seasonal chart ever could. This is where it gets really concerning if you're only paying attention to Bitcoin headlines and ignoring everything happening in the broader economy. A single sentence from a central bank official, delivered during a routine press conference, has moved crypto markets by billions of dollars within minutes before, and it will almost certainly do it again. That's the environment we're operating in right now. One where a policy decision thousands of miles away from any crypto exchange can dictate whether this August plays out calmly or chaotically. But there's one more signal that might matter even more than all of this macro noise combined. Most investors are completely ignoring it. Forget the price chart for a second. Seriously, stop staring at the candles. The people who consistently make money in this market aren't obsessing over the price itself. They're watching exchange balances to see whether coins are flowing off exchanges into cold storage, which usually signals long-term conviction rather than short-term speculation. They're tracking dormant coins, meaning Bitcoin that hasn't moved in years, waking up and shifting wallets, which can sometimes hint at early distribution from long-term holders. They're monitoring whale wallet activity, miner selling behavior, open interest in the derivatives market, funding rates that reveal how leveraged and emotional the market has become, and stablecoin reserves sitting ready on exchanges, which often act as dry powder waiting to be deployed. Why do these signals matter more than price? Because price is the last thing to move. It's the result, not the cause. By the time price reacts, the smart money has often already positioned itself weeks in advance. If you look back at previous August bottoms throughout Bitcoin's history, you'll notice something consistent. The real turning point almost always showed up in these underlying signals first, quietly, long before the price chart gave anyone permission to believe it. This is exactly why so many retail investors end up buying near the top and selling near the bottom. They're reacting to price, which is always the very last piece of the puzzle to move, instead of watching the quieter signals that tend to move first. If there's one habit worth building after watching this video, it's learning to look past the candlestick chart and start paying attention to what's happening underneath it. You need to understand this before I show you what's coming next, because the next part ties everything together. Based on everything we've covered, there are really 3 ways this month could unfold. The first scenario is history simply repeating itself. Meaningful correction hits. Fear spreads across social media and headlines, weak hands capitulate and sell near the bottom. And then, following the same pattern we've seen in past cycles, a strong recovery eventually follows once the selling pressure exhausts itself. The second scenario is a frustrating sideways grind. Neither bulls nor bears get what they want. Bears grow impatient, waiting for the big breakdown that never fully arrives. Bulls grow restless, waiting for a breakout that keeps getting delayed. But underneath all that frustration, energy quietly builds for a much bigger move whenever it finally decides to release. The third scenario, and honestly the one that would surprise the most people, is the pattern simply breaking. Institutional demand overwhelms the seasonal weakness entirely. Short sellers who bet on the August curse repeating get caught off guard and forced to buy back their positions. Triggering a short squeeze, momentum accelerates in a direction almost nobody was positioned for. Notice something about all 3 of these scenarios. In every single one of them, patience ends up being the deciding factor between the investors who come out ahead and the ones who don't. Scenario 2 rewards the people who don't get bored and abandon their position during the sideways grind. And Scenario 3 rewards the people who were already positioned before the squeeze even began. By the time it's obvious to everyone, the best part of the move has usually already happened. So here's the question I want you to sit with for a moment. Which of these 3 outcomes do you think the market is quietly preparing for right now? Type your answer in the comments before you finish this video. I genuinely want to see what you think, and I'll be reading through them. Here's something worth remembering before we wrap this up. Every major Bitcoin cycle in history has shaken out impatient investors at some point before the next real move higher. That's not a flaw in the system. That's the system working exactly as it always has. August has repeatedly created fear throughout Bitcoin's history, and in many of those instances, that fear showed up right before longer-term trends eventually resumed their course. History doesn't guarantee anything about the future. But ignoring history entirely can be just as dangerous as assuming it will repeat itself perfectly. The investors who tend to do best over the long run aren't the ones who correctly predict every single monthly swing. Honestly, almost nobody does that consistently. And anyone claiming otherwise probably got lucky once and never stopped talking about it. The investors who do best are the ones who understand the forces at play, size their positions sensibly, and refuse to let a single red month convince them that everything they believed about the asset was suddenly wrong. That kind of patience isn't glamorous. It doesn't make for exciting headlines. But it's usually the difference between the people who build real wealth over a decade and the people who get shaken out right before the recovery begins. So here's my honest question for you, and I really want an answer this time. You think Bitcoin's August curse strikes again this year? Or is 2026 finally the year this pattern breaks for good? Let me know in the comments below, because I read every single one, and I'll be replying throughout the week. And one more thing before you go. What's the weather like where you're watching this from? Sitting inside avoiding the heat, or somewhere cooler this time of year? Drop it below. It's always interesting to see how many different corners of the world end up watching the same video at the same time. If this video actually helped you understand what's happening beneath the surface of this market, hit like right now. It genuinely helps this channel grow. Subscribe if you want more breakdowns like this one, because we cover markets, money, and the patterns hiding in plain sight every single week here on the Wealth Continuum. And if you know someone who's been nervous about their portfolio this month, someone who keeps asking whether they should sell or hold, share this video with them. It might be exactly the perspective they need right now. Thanks for sticking with me through this entire breakdown. I'll see you in the next one.